Yes, meaning is being reporting.
Hello and welcome back to the ROI channel, the channel that's obsessed with the art and science of return on investment. We have the controversial CFA from the
CPA, not
CPA. I'm
CFA.
sorry, whatever.
Don't
All right,
confuse
I've
me with the
messed it.
CFA.
All right, I've messed it up already. I say proven resources instead of reserves and all the rest of it. Anyway,
I'm
we're
not
getting straight into it.
resources. What are you
Uh,
talking about?
I know, I
That's a
know.
whole
I'm
different
sorry.
category.
Chapman Scarborough's back. I'm going to give him the floor. He's going to show the universe of Twitter haters what he's going to back up his statements around uranium. We're going to talk hopefully Petrobras and Ecopetrol. I would love to get an update on New Fortress Energy,
Oh,
shipping, which
yeah.
is going through the roof, Sibanye-Stillwater, and whatever else we get to cover. Guys, disclaimer, nothing we say is advice. Do your own due diligence. And just because I'm listening to Chapman doesn't mean I always disagree with him. We are able to disagree without fighting each other. It's not that hard. So, Chappie, the floor is yours. We're going to pick it up. Uranium, you put out a little tweet saying sell it all. What did you mean by sell it all?
All right. So sell it all basically. Some people were to say that, oh, I was actually like short uranium. Like, no, I'm not. And in the grand scheme of like of essentially a positioning call that you would say like sell, buy, all that.
Yep.
Um,
Which I understood. Yeah.
which is to basically say like this is a point where you might want to be looking at protecting profits. Um, and having said that, it's mostly due to the fact that let's just say everything out there is I how do you put this? Vastly
Fully priced. Could we say
I mean
fully
fully priced
priced?
and like then some. Um, there isn't. There's like one exception to this, and we're, if it's up on the screen now, we're looking at it. It's not Boss. Boss was a sort of a principal example. Paladin's going to be pretty much the same story, but and basically the point that I was saying, like Boss in particular, was one of those tweets of like,
Yeah.
sell everything today, sell Boss in particular,
And
and it.
they've just done a cap raise, right? Or they're looking to do a 200 mil cap raise,
Oh,
something like that.
a two
Did you see that?
million? Is that
Yeah.
it?
No, 200. Did you see that
Oh
in the
God.
feed today? Because
200.
they this is look. I have just woken
Go
up. I
on,
could be
please.
wrong. Because they need more. They need more uranium, and so I believe they're looking to do an acquisition. So don't fact check me too hard, guys. So I'm just going to put it out there. That's all.
Well,
I'm
they had
sorry.
the
The
notification
floor is
regarding
yours.
unquoted securities. That was on the 28th. I'm looking at it right now. And it looks like they were going to raise, or was it like mm, looks like it was executive compensation, but well, no. Some shares an issue. Yeah, it looks like those are just performance rights, I think.
Okay. Okay.
Um, there is some rumors that they're maybe looking to buy somebody, but I mean, they're starting a drill program in Jason's deposit, which is something that's to the northwest, excuse me, of Honeymoon. Um, and they're trying to increase their resource, which I okay, good luck. Um, the problem with Boss is let's get a little bit of background here. All right. So in terms of in situ land in Australia, you have Honeymoon, that was a mine that was built by Uranium One, but never quite worked out because the essentially the process that they were doing the in situ extraction with was, one, not good, and two, the one thing that a lot of people don't really talk about, it seems, is that it's also fairly low grade. Versus, let's say, 4 Mile and Beverly, I believe. Well, the 4 Mile and Beverly deposit, which is to the north of them, has basically twice the uranium grade ore grade that they do. So it's like a 1,200 part per million deposit, whereas Honeymoon and Gould's Dam and Jason's deposit, or whatever it is, it's a very small deposit.
Okay.
Was
So they're lower grade
Yeah, so
deposits.
it's more like 600 parts per million, 600
Yeah.
to 700 parts per million.
Okay.
And you have a whole class of these deposits in this range that never quite made it in the last uranium cycle. So we're talking about like
Which you would think
Shirley
because
Basin.
so you've got here the uranium price of 140 USD. That's basically the old time high. So if it
Oh
wasn't
yeah, that's
feasible, if it
actually,
wasn't
and this
feasible
is,
back then, how's it going to be feasible today?
well, let's zero out a few things here.
Yeah,
So
you like my segue? Yeah.
yeah, exactly. Because I just looked at like the production delta here. So when I said to people that Boss was currently being priced for like well over $200 uranium, one,
Yeah,
you have to
let's unpack
realize that
that.
one, that's in Australian dollars for one thing, but it's still fairly up there. So let's
Okay.
just say that you were to take a 10,000, for this point, it's Australian dollars because we're talking, because I prefer to buy this on the ASX exchange. And I tell people just to buy it on the ASX exchange
Yep.
anyway, and not deal with all that over the counter BS. If you were to buy it, I think, let's see, what was the price last night? Closed at 415. So let's just change this to, I need to come down here and change that to, I think it's 415.
It'll do
Is
for
that right?
illustration purposes.
For illustration purposes, this was the one I needed to change.
Okay.
So you were to go in here and, okay, great. That's cool. No, stop that. Damn computer. Did you no, I don't want to replace it. Okay, thank you. Equals that. I just want to make sure that this, if we have to do this in the future again, and okay, good, we're up there. So you were to buy a $10,000 buy of Boss shares, okay, which basically account to roughly speaking 4,900 and some change.
Okay.
Um
As of, let's just say
4,910
that price, as of last night's closing
as
price,
of last night's closing.
415 Australian.
Great. So that would be 2,410 shares,
Shares.
just as an example. All right. Yep. If you were to maintain that investment, all right, at that $10,000 investment versus an 8% benchmark over the production period of Boss, right now at $213 per pound Australian, or $140 pound term, which nobody has even signed yet, and we're not even remotely close to in terms of a term contract ever being signed. I
We'd
don't
be
even,
double. Yeah, that's double
that
from where
would
we
be
are
a
right
record by some very appreciable margin.
now.
You would be looking at, just from Boss here, you would be looking at a 67% profit over this production period minus 3 years. You'd assume
Assuming
you'd
nothing
get out,
goes wrong with production and all the rest of it.
which we can account for. Don't worry.
Oh, okay. Okay.
If you were to just to take that money and take that $10,000 and do an 8% benchmark investment, your return would be 133%.
Okay. Over how many years is that?
Over basically 10 years,
10 years.
essentially,
Okay, fine.
because it's because we're assuming year one, so production's next year, and then basically we assume that you're going to sell in basically like give or take 10 years.
Okay,
Let's just basically
so
say
my
2030.
hurdle rate is, we're saying 8%.
We're saying
And
8%. I mean,
so
because if you take,
if I have to
yeah,
get for me to get a more compelling opportunity, I'm just dumbing it down for people like me, I need to beat 133% over roughly 10 years. So
correct.
does Boss in all likelihood give me that opportunity? That's what I want to know.
No, it doesn't. Because this is the other part of Boss. Boss, the current production plan is not actually that high. And okay, now this is where you have to get into the weeds here, and you have to decide, are they being conservative? Are they not being conservative? I have to give this a fairly good margin of safety here, because remember, this is a deposit that didn't work the first time. Like 10 years ago, they couldn't get this thing to work. And they had to wait for higher uranium prices to come around to see if they can actually make it possible, right? So now we're getting to that point where that higher term contracting rate of, let's just say, 70, 75, $80 a pound is making these 600 part per million deposits in situ possible.
Mhm.
Compared to, say, let's just say Kazatomprom. A lot of people really think like Kazatomprom is like really low grade. Like, no, it's not.
No, that's the highest grade in the world, isn't it?
Their in situ resources is about 4,000 parts per million, or 6,000 parts per million, I think. Yeah, that's about right.
Okay. The 10x,
Which is
the grade of
correct.
honeymoon.
So they're able to do, when you're looking at them and you're saying like, okay, well, this is what their production cost is. Granted, they're putting a lot more into it than, let's just say Boss could ever afford. Kind of infrastructure that would lower cost over time that just doesn't
For sure.
make this economically viable. So Boss has to sort of get by with less, let's just say. So, there's that part of it. So let's just say there's the second part of this equation, which is, if you are currently a holder of Boss, does it make sense to hold, or does it make sense to get out now? Like,
Okay.
has the point of where this doesn't, where you're putting a lot of risk on the table,
the upside
for
downside equation has changed essentially.
Exactly. Like
so
the
that's where
upside
you're
downside.
saying sell it all. And I interpreted that as, okay, if you owned Boss, now's a good time to sell. Just because he said sell doesn't mean you go short.
Well,
That's
look at it this way. Like, you could potentially get back in at a fairly similar price. Now, some people are going to say to me, well, Boss could go to $6. Well, sure, it could be priced at $300 uranium. I don't know. I mean, why not?
Yeah.
It could do that. But the question is like, I'm not the only one here who's done this math. And a lot of the big money people, let's just say, are out there. They're willing to put that risk on the table that, that the greater fools is going to drive the price up. Why is that? Because in every, because in every commodity boom market,
it
the price has
overshoots and we get
always
that
overshoots.
whole, exactly. But
I'm arguing that it has, and that we've reached that overshoot here.
The overshoot. See, that's where I'm not so sure. Again, I can't validate this.
I can't validate it either.
Yeah.
But I mean, but when I look at the underlying fundamentals of the assets here, Boss is just a hard sell right now. This is a total take profit. If your basis in Boss is $1.30 a share, all right. If you were to hold that through production, okay, your current profit is right now 228%, just capital gains. Okay, your final profit, if you held through production, including dividends and basically a small residual here, is going to be 432%.
Okay, over the entire holding period.
Over that holding period, correct? Yes, over this holding period of essentially 70% of this mine's production. All right.
Okay.
If you were to sell and just basically invest in SPY, and this is why I say the benchmark return. It's why everybody uses an 8% benchmark return, because that's what basically the index produces every year. Is 8%. Okay, so that's the benchmark here. If you were to just say, like, I have an 8% benchmark investment, or you have another investment,
whatever instrument, sure,
and whatever, or you have an instrument, or you have something that you're fairly certain is going to double, then this is an absolute no-brainer. Okay, then if you were just to basically reinvest into the index, your final profit is going to be 664% over what your holding period for Boss would have to be.
Yeah.
So when I basically say, like, versus a Boss hold, you're going to make $23,000 more if your basis is $1.30. If your basis is $2.07, you're going to make $14,000 more.
So that final column there that you're illustrating is the total profit versus the Boss held at various.
That's your additional profit that you're going to gain by going to an 8% benchmark investment. So let's find out, like, what would uranium have to be for this to make sense, for you to hold? Okay, let's go to $170 uranium. Nope, let's go to $190 uranium. Finally, you would have to have $190 US uranium, and that would be approximately $289 Australian for you to actually beat the index. For, you know, essentially, and that counts as like that sort of puts in a different category, because if, as it relates to everybody here, because the higher price basically makes this not only a hold for the people who are long term, but it also makes this a hold for the people that just bought last night. All right. Last night in my world, yesterday in Australian land.
We are from the future. Yes.
Exactly. Yeah. Yesterday in tomorrow. If you bought tomorrow, then that's where you're at.
Yeah.
So
Okay. Fine.
To me, this is a little bit fanciful, because one, there's so much deposits out there. There's so much out there that's going to come on the line, that this is your price that has to be $190 over the average of this production. Okay. So that's a long time.
It is. So inflation adjusted pounds, and people argue that, oh, well, if you adjust for inflation, the new all-time high would have to be.
Okay. I mean, sure. I mean, we could.
Then again, what
there
happens
is
to the expense column in such a
exactly. So, all right, let's go back down to, let's just say, we have a couple different metrics. We have the SG&A delta. Now, the SG&A delta is essentially benchmarked to what Cameco's costs are. It's how I've also benchmarked NXE's costs. Everybody else's SG&A cost is basically just benchmarked to production. It's just it's a
So
certain amount of production.
In
it's
a
just
producer
fairly
like Boss,
standard.
that's been quite generous to them, really.
Potentially. I mean, sure, yeah, we're going to. So I mean, I'm saying here that if they produce, $390 million of revenue in year 2, that their SG&A cost is going to be 16.4 million. That's being fairly generous, potentially.
Yes.
How much bonuses are they going to pay themselves? I don't know. But we know their tax rate. We know the royalties. We know, and we know generally as well how much infrastructure, how much money they've spent to basically get to this level of production. Now, there's been, let's just say we want to increase production by, to get to 20%. Now, if we're doing a production increase of 20% here, I'm saying that your CapEx delta, which is essentially what your sustaining CapEx is going to probably be doubled for those next pounds, because you're going to be chasing more far-flung resources. It's going to be resource that's farther from your processing center. It's just going to be more expensive.
Yeah. Okay.
Okay.
That does make sense.
So you're going to be looking at, a cost of like $24 a pound to increase production by 20%. Now, if you increase production by 20%, how far does uranium, what's your bubble in uranium before you're now going to be, before this becomes a whole?
Current estimate of lifting costs, let's call them? And I'm speaking kind of oily.
So the current estimate is going to be like $30 in total, all in sustaining cost.
Is that Aussie?
Is like $28 basically.
Okay.
All in sustain. So, and that's
Aussie
an Australian
US
dollar.
Yeah. Okay.
Gotcha. It's Aussie. So, although that might be US. I'm not. No, that's probably, that might be. Yeah, I think that's actually US dollars, because we calculated this up here, and then we basically.
Seems pretty high.
Yes, I mean it's because it's a low grade resource. People need to remember that it's like in the middle of nowhere for one thing. You got to fly everybody out by like jump jet,
Everything's
or by
in the middle of nowhere out here, mate.
Yeah,
okay,
exactly.
Fair enough.
So, it is fairly high, yes, but overall, $24 per pound is not, and if you're selling uranium for, well over $90, who cares?
Yeah, exactly.
Okay.
That's justifiable. Sure.
So, but I like to think that that's a bit of a wiggle room there. And that's sort of based on what their sustaining CapEx is. But essentially your total increase is, you're going to be looking at, CapEx of $90 million for an additional nearly about 4 million pounds in production, 3.89. So let's just say 4 million. And that's pretty much in line with about the approximate overall, your costs go to about $15 a pound, like in terms of what you're actually depreciating. over time. Now you have your operating cost. So I mean, you have your all-in sustaining cost that I would estimate is about $18, and then you have overall, which is once you count for everything, it's about $15 for just the not the overall, but for the fixed asset part of it, which is the sustaining and initial capex outflows. So even if you were to do that, all right, so we can come down to, let's just try 170.
Okay.
So you get basically like a slightly higher window of like where this sort of makes sense. Okay, so we can go down to 165. We're at $165, and we're basically now at the threshold where if you are a current holder, it makes sense to sell. So even if you increase production by 20% and you're assuming $165 US uranium, you still it makes more sense to sell.
Contracts too, right? Like we're not talking spot here. We're talking.
This is talking essentially the term contracts and basically whatever the average price for every pound of uranium that they're going to sell
produce
over this production period.
Yeah, production period. Okay. Yeah. And so this is where your statement of boss is currently discounting $250 a pound comes from.
Pretty much. Okay. Yeah. I mean, assuming, let's just say, 20% production increase, which is what they want to do anyway. So we're going to say they're going to do that. And it doesn't cost them a whole lot. Like they're all in sustaining for that that additional is not going to be that expensive. They could do that. They could afford to do that. They've got plenty of cash here to be able to afford that. They can do that. But the question is it going to make sense for you to continue to hold it? The answer to that question is probably not. If you were to basically come in here and just assume what a Boss share price would be, and you were to assume, let's say, $95 US uranium, $144 Australian for the life of the mine, and you were to just buy this tomorrow, let's just make that so this comes from there.
What are their current? See, I sold Boss ages ago, so I don't follow the company. Have they got term contracts signed?
Not that I know of. That's the thing. Like, if they have an offtake agreement, they haven't really talked about a lot of them.
I know they own some physical yellow cake, and they were buying up.
And I actually have that in my stockpile sales. Okay. So I'm glad you asked. I'm glad you pointed that out. Because as the mine is coming into production, in my opinion, what they're going to do is they're going to use their stockpile to basically fulfill their term contracts. Because which is fine, because in a lot of ways, if you're if you want, when you're a utility, you're contracting with a producer, you want to know that they're going to be able to deliver. So before you like establish a production record, let's say, you're going to use your existing pounds to basically ensure that instead of basically buying, let's just say you want to sign a 2 million pound contract. Well, you can't do that unless you actually are using your stockpile sales here to basically pad your production numbers. And then you've got, in year 3, you can assign an additional contract for an offtake agreement. I mean, however, they want to do that. But that's what I think they're probably going to do, because it's a good asset, and I don't think they're going to get rid of it. Or I don't think they're going to, I think they're going to get rid of it in that way, because it makes the most sense while you're ramping up production to basically use that to pad your
smooth over that
exactly
transition to getting to production. Okay, well,
yes, yeah, makes a lot of sense. And you could potentially sign somewhat at a higher rate, even though, let's say they want more pounds per year, and you then don't have to go into the spot market to buy. So there's a whole host of reasons as to why that would happen. But we haven't even accounted for inflation cost yet. Let's say that actually inflation actually doesn't matter that much, but let's just say that, it goes up by like 5%. Well, that brings our cost per pound our operating cost per pound up to like 1938. And that changes things too. So, I mean, but let's just say we have a $95 term. We have a 20% increase in production. What is the fair value of Boss? Let's just say you were to buy it at $1.75. close. Let's see here. No, we're getting closer. So let's just say $1.90 would be pretty much your fair price there.
Price. Okay, that's a long way down from where we are now.
I know.
Yeah. And we need a long way up on the uranium price,
But see,
which
and a
we
lot of
just
people might
saw
say,
to make that
exactly. And a lot of people might say, well, okay, I'm holding at $1.30. Well, okay, great. But you also have this huge capital gain.
This is true. Yeah.
That can be deployed elsewhere. It's sort of like you've now made the money. Maybe it's time to move on. Now, let's just say, for instance, you were wanting to look at something else, like, because I did say that there's a mine out there that actually makes sense, and it's Global Atomic.
Even in its phase 1, and it's not all of the mines, only about 20% of it.
Yeah, exactly. So I'm gonna switch over the screen share
So
here.
if we were, what if I were to do something crazy, hypothetically, and sell my boss shares, which I don't own, by the way, guys, remember, sold them before, and roll them into Global Atomic, because let's just say I believe in the uranium thesis. I'm looking for a uranium developer, pre-production in that sweet spot. Yeah. Take it away, Chappie. What am I looking at?
So if you were to do that, and I think we're currently trading at $1.88 on the OTC exchange. I don't know what it is, if they have an ASX listing or not.
I buy them on the TSX.
Yeah. So let's just say that you were looking to get into this mine at this price, and we wanted $75 term. Your delta return for this at that price, $75 a pound, is going to be roughly 175%, and you are going to beat a delta. Your delta versus an 8% return is roughly $12,700.
Okay, so explain that. So that delta as a percentage term. So my profits are looking at 100.
That's basically what your
versus 133% over 10 years. Yeah, right.
Essentially, that is what your return that you could expect from. Oh god, where did I put this? K4. Okay, so that is what you could expect over what IV13. Okay, there we go. I mean, there, V103. Okay, there we go. So that's what basically you could expect over a certain number of years if you were just to take $10,000 and expect an 8% return annually. Okay. This is what you would gain in a boss investment over that benchmark 8%, which is roughly $12,000.
In Global Atomic. So if you rolled it into Global.
Yes, in Global Atomic. Yes,
yeah, that's right. And they hit their numbers, and the new government has now been officially recognized by your government, I see. So
exactly.
We should it should all go.
So you have a little bit of de-risk here, basically. But this is essentially a double right now, without a doubt. Even at $75, a very reasonable price. What price does this investment actually not make sense at? $60 a pound still makes sense. $55 a pound still makes sense. $50 a pound. That's your margin of safety with Global Atomic, is $50 a pound, is when it does not make sense at this price. So yes, there's a huge amount of political risk here, but this is the mine that I hold. Because, and I know
a couple of months back when everyone was panicking.
Oh, I know. Well, I mean, I said to people, like, look, I'm pulling guidance from this because it was an unknown situation, and look, and it dropped by 50%. And yes, do I wish I bought it down there? No,
I'm just simply more degenerate
in hindsight. But even then, even if you didn't catch that bottom, this is
as of today's price
deal.
No,
look, Roman is serious. He wants to get this done. He is going to get this done, and we're assuming 10% on their loan here by the buy. And this is also accounting for basically the 80% share to Global. How much of the cash flow is basically going to go back into Niger? And essentially, we're just calculating this just solely on dividends. Never mind, I'm not calculating this at all on a PE ratio. Now, I think you could potentially give it a PE ratio, but I'm also a little bit hesitant to give, mines that have less than, let's just say 20 years of production potential, a PE ratio, because it's a
In
declining asset.
probably not a tier 1 jurisdiction, let's say. So
Yeah.
fine. But they do have the phase 2 potentially. It's a massive deposit. I mean,
potentially, yeah. I mean, but there is some criticism of that they're high grading sort of from the very beginning, but
everyone
we'll
does
see what
that.
happens. I mean, everyone, yeah, exactly.
You get
But
the easiest resource first, not the hardest one.
Let's just say that uranium goes to like $145.
Ooh, what am I
This is
looking
a
at?
6x return.
Ooh, yeah. Now we're talking.
And so basically, I think you got to decide here, one, the calculus for a current investor in uranium is, all right, how much higher can the fever pitch go? Now, you could say probably another, let's just be safe and say probably another 50%. All right. That generous and say another 50%. Safe, whatever you want to say.
Spot price.
Yeah, or just the price of the equities themselves. Like,
equities,
Cameco has gone
as I
higher in the
understand it,
past.
they've kind of lagged behind the metals price. Just using a ratio.
Yeah, sometimes, yeah. I mean, it's sometimes it depends. I mean, the market is a flows machine, as we all know. So, if you got more money flowing in than flowing out, then the price is going to potentially go up. To me, you've got to balance that, how much potential there is there, taking your gains, putting it elsewhere, or you have global here, but you've got the political risk, but you have a massive upside
with a margin
and
of safety.
it is in a margin of safety to $50 a pound.
Yep.
At the current price.
And I think that political risk has been significantly decreased given the events of the last few days. In addition to which, so let's talk, say, Denison, which I think is interesting, and global I think is interesting. Everything else doesn't really. Well, a few, I guess, of the Swedish gambles could be interesting.
That's a gamble.
But it is a huge speculation.
Yeah, I know the Swedes they're going all in on the nuclear, right? But it's also like, how are they going all in on the nuclear? Are they also going all in on the mining? I don't know yet.
Yeah, exactly. We don't know, and so we should only stick to the fundamentals.
Yeah.
Denison, I'm sitting on some profits.
Sure.
Am I going to roll that into Global Atomic now, or am I going to have a look at another sector? I mean, why am I going to? I mean, Ecopetrol feasibly, double-digit dividends. Petrobras, double-digit dividends.
I like where you're going with this. So, there's been some news over the last tweets. Let's just say news. I don't know. Let's just call it tweets of some fairly prominent investors in Petrobras, basically deciding that they're going to exit here. And they see a lot more risk, or that there's more political risk now. I guess. I don't know. To me, Petrobras is a growing asset. All right, they have production figures over the next several years that is fairly conservative.
And I mean, regardless, that same analyst, the Brazilian analyst that I tagged you in and commented, Fede has said to me, he said, look, no matter what happens over until 2030, Brazil will be the number 5 producer in the world, regardless of of what else happens. So
yeah,
let's talk Petrobras then.
Had a little bit of a pullback here.
Little bit of a pullback, and it's the same calculation. It's saying, well, what's my upside if I hold? What are my other opportunities? Is there a more compelling opportunity in a world-class, fully vertically integrated super major?
I mean, even the YPF, I believe, if you're gonna go look into Argentina, I think that's actually trades at a higher multiple.
Don't do Argentina.
Yeah, exactly. Just don't do Argentina. I mean, Argentina's there's things have got to settle there. To be fair to Denison, to your question, I don't have a projection for Denison. because Denison's value is solely based on whether they can get in situ working. If they can get in situ working in the basin, then Denison,
Game changer.
God knows what their price is going to be. I mean, it's going to be up there because they're going to have the technology. Hopefully, there's something patentable there that they'll have a mining method that they'll have the rights to, that could potentially just change the way that mining is done in the basin.
They've made progress so far in terms of what they've been able to do with the ISR.
Yes. So, but there's a long way to go. There's also regulatory regimes and other things. And I honestly haven't looked at it that much. I think I haven't looked at it closely lately, but I agree that there's a lot of really solid potential there. Having said that, I think the margin of safety in global just can't be beat. I mean, even if you were to discount, like, all right, look, if you're assuming $80 uranium right now, even if you were to, let's just say discount that by 50% or something like that, or discount your total potential return by 50% from political risk, still no brainer. So it's hard.
What position weighting? What allocation?
I mean, it's speculative. Exactly. I would still rank it in speculative. So this isn't something I would not go into global in the kind of size that I'm in like Petrobras or something like that. Of course, no. Or even New Fortress, actually. Yeah. But it has such insane upside that, and we're now talking about something that if it potentially gets a PE ratio, because it's going to be a longer term asset, then that's just a game changer. Then you're looking at like selling this thing at like $9 or something ridiculous.
Yeah. A potential 10 bagger. And I did write.
Exactly. So to me,
that I do think it has 10 bagger potential.
I do think it does too. I mean, and remember, global is the one deposit in Niger that the French missed. This is a new deposit. It was drilled new 10 years ago and discovered a little over 10 years ago, around about that time. It was the one area in Niger that the French didn't drill.
I don't think anyone's going to cry too many tears for the Frenchies. But anyway, with all due
probably not. But having said that, the reason I say that is that this is a new deposit, which is what makes it supremely viable. Yes, has it been? We could debate whether it's been unfairly sold off or not. But I'm saying right now, like, I have investments at this at like $1.80. This could go to $1 and if nothing really changed, I would not sell. That's the kind of confidence that I have in this. So
makes sense.
I'll put it to you like that. I might sell if it goes below $1, but we'll see. But having said that,
it all depends. Yeah. I mean, that's price action. That it depends. If nothing else changed in the underlying fundamentals, well, then I'm lowering my average entry. So there's where we agree. I
mean, and the other thing, like if you're looking at something like a Petrobras, I mean, look, your dividend alone in Petrobras is going to beat a benchmark index return.
Still.
So
yeah. Especially if you buy the PBRA, the preferreds. So
exactly.
So why? This is what I got to understand. So why am I going to sell? I'm sitting on great profits in Petrobras. So why am I going to sell when I'm still looking at close to 15% yield on the current price? That's not yield on cost. Current price. And my yield on cost is close, over 20%,
like 30. Or something almost like that. I mean, it's like my basis in Petrobras is something like $10.80.
Yeah, very similar.
So I mean, it's great. I have no intention of selling that. There's been one red line that I have said, and that's if Lula fires Parades. But as long as that doesn't happen, I'm happy. So to me,
I hope you haven't jinxed it. Like I
hope so. I mean, they seem to get along. And look, if
he appointed Pradesh as in the first place,
and they do actually sort of seem to know each other. And look, Petrobras is a big part of the stock market.
It is. There. I've just uploaded a chat I had with Patrick Flood on the weekend. The Bovespa actually has has had a lot of downward pressure this
I
year,
just call it B3.
but you don't see the price movement because of Petrobras. It literally has carried the thing on its shoulders.
Exactly.
Yeah.
I
So
know.
to your point, yeah.
So if you mess with Petrobras too much, you're gonna risk collapsing the Brazilian stock market. Which
And in addition to which, a lot of people don't seem to pay attention to the credit markets in Brazil, but there's almost an 8% real yield on sovereign bonds, and they're cutting rates moving into the end of the year. So I don't look. I don't think a lot of capital is going to flow into the. Say that again. Sorry.
Which is why they're so sensitive about diesel prices, because the central bank apparently takes fuel prices into account, like to a fairly high degree in terms of their inflation calculation, which whatever. So look, there was a lot of pressure on them, let's just say around August, to take some losses on diesel. Or not really take some losses, but break even, let's just say. I don't,
They're
whatever,
still importing a
going
lot.
on.
Like, or not really.
Not
Still
really,
importing
no.
a
I
decent
mean,
amount from Russia?
the importing costs have actually gone down because the refining utilization, they've sort of figured out this playbook, and to some extent Ecopetrol has also copied it, in that if you use your existing refining assets to like the best possible level, you have more flexibility with keeping the government happy.
You don't need
In
as much
terms of fuel
diesel
pricing.
or yeah.
So so to me,
yeah.
you know, I mean, I think, look, there's been so many cases in the past where you've seen assets that, you know, you could look at coal assets from a couple of years ago. You can look at, you know, and you can look back into the 2000s at Brazilian assets, and you could just see the moves they made. They didn't double, and they didn't just stop at a double. My long-term price target on Petrobras remains $45 because I think that's what it's worth. And to me, you know, I'm not going to get shaken out just because the Minister of Mines doesn't know when to shut up.
Yeah.
I mean, which is what's going on here. You have Silvieri, or whatever the hell his name is, basically just, you know, who needs to just stick to his own damn department and not act like he's the CEO of Petrobras.
Exactly. And I mean, you're getting paid to wait. There is no penalty really on
That's the
it.
problem. Exactly.
Yeah,
So if you're in an underpriced asset, the most important thing you want is you either have a line to growth, and you know that the revenue growth is going to come, or you're getting paid to wait. And Petrobras, you're going to have both. Because, you know, and if we find, and if they go into the equatorial margin, which, by the way, Lula is pushing them to do, that wasn't happening under the prior administration, to the extent that it is happening now. And I would also point out, like, yes, we're increasing CapEx spending. Well, you know, we're also putting another $10 billion in exploration and production.
Yeah, exactly.
So
it's
what's there to complain about?
Yeah.
All right. And look, and the overall IRR remains above 20%, which means, in my opinion, Petrobras should maintain that insanely amazing over 20% net margin that no other integrated has on this planet. Petrobras is the most popular, or not popular, not the most popular. It needs to be more popular.
It does.
Most profitable oil company integrated on the planet, like bar none.
Yeah.
This is
that size. Yeah.
For that, yeah, exactly. And this is with all the government interference. Like, people are talking like, oh, the government's coming and interfering. And it's like, guys, if the government like shaves like 1 or 2% off the bottom line, who gives a shit?
Exactly.
I don't. It makes twice as much money,
cost of doing business,
on a dollar basis as Exxon.
Yeah.
Oh, and Exxon now has a whole bunch of problems in Guyana. So, but, you know, who knows what's going on with oil right now? I mean, you know, that's where you're getting a little bit weird, like antsy, you know what I'm saying, with like oil, because it's like, you know, who knows what's gonna happen.
So Petrobras's fully allocated cost of production, where's your estimate?
Oh, I think it's about $35 a barrel.
So why is everyone making noise? Because the oil price is in the 70s. Can you?
I mean, they make less money in the they make more money in once you get to like the 80s and 90s. Well, that's where we can maintain the current dividend. But if you're in like the 70s to 80s, I mean, yeah, you're gonna have a little bit of a cut. Not that much.
You don't need to wake me up. You don't need to wake me up from my nap until oil's at $100, right?
But our production increases might just take care of that. So it's like I don't have anything better that's happening right now. Now, New Fortress Energy.
Oh,
So as you can imagine, there is a certain ship
so first of all,
called.
Chappie absolutely nailed this. Let's just be
Oh,
clear.
it's happy. Thank you, and I've nailed it several times. There was a certain ship that was up in Corpus Christi.
Interesting.
Now, everyone is going to be wanting to pay attention to this. So,
All right. Let's hear it.
let's just come over here and let me try to share a screen here. There we go. So we're going to go over here to, I think it's that. No, wait. No, that's not it. Trying to find this darn thing.
We'll find it. But New Fortress Energy,
Anyway.
I mean, buying below $30 and the price action over the last month has just roared upwards. We nearly touched $40 and a little bit of a cool off this morning, I see. But this thing, what's this thing worth, Chappie? Like, is this $100?
Oh, it's worth into the 90s. I mean, honestly, it's so damn cheap in terms of like what it actually of what it trades for. So,
The one issue people give me when I shout the praises of New Fortress Energy from the rooftops like an evangelical Christian is where's are they actually going to stop capex now and
yes,
pay down the debt?
that's what they said they're going to do. I'm going to believe them. So,
Me too. Until they prove otherwise, like whiteheaded.
So there was a certain ship that is supposed to be attached to the FLNG, fast LNG down in Altamira.
Okay.
And it was up here in Corpus Christi for a long damn time. Guess what moved this morning?
So explain this to me. So fast LNG, this is one of the New Fortress fleet, or what is this?
Fast LNG is let's go back here. Fast LNG is the liquefaction offshore that's in the on those repurposed oil rigs in Altamira.
So you don't have to take the gas, pipe it to the onshore facility. You can just pipe it to one of these things. It liquefies it.
Well, it actually
on the vessel.
No, well, yes, it does, but there's a pipe here, the Sur La Texas or the Ben Sur, whatever the hell it is. It's the big pipeline that comes into Altamira, basically. Okay. And that is, oh God, where is it? Yeah, there we go. Pioneer 3. There we go. And here, where's it headed? Yeah, I think it's headed right here. There we go. Destination. Is this Pioneer 3? No, it's not Pioneer 3. This is Pioneer 3. This is the location of that rig right now. Okay. And it's on that pipeline. This is Penguin. It's headed to there. What does Penguin do? Penguin is the storage vessel. So as this facility that you see here liquefies, there's 3 of those, by the way. There's 3 of these little jackups, basically. It goes into the storage vessel because it has to have some place to go in between. And it's just an LNG carrier. It's an LNG carrier that will just be moored alongside, basically. And it will just serve as a storage tank while you have other LNG ships that will then come alongside and then take that cargo that will be transferred from the Penguin, and then they go on their merry way. But you have to have some place to store it, and Penguin is the storage facility.
Okay, so it's a floating storage facility more than anything else.
Correct. Right. So if they're moving the storage facility here, First Liquid is not going to be far behind. So... And that's, I think, one of the things that, now there's some people that disagree with me on this, but we'll see what happens, okay? I think that the announcement of first liquefaction is going to be huge. Probably 5 to 10% up on that day. Because it will confirm
proof of the concept, right?
Yes, it's proof that it works. Yeah. which is what, and you have to understand that fast LNG, in terms of what the analysts out there have priced New Fortress at, have completely disregarded it. So like they just don't think it's going to work or whatever.
Okay.
So once it does work, and it's going to happen here fairly soon, I think New Fortress is going to be is going to see some we're going to be over 40, in my opinion. Look, we've been up there in the past, and I think we'll be up there again. It's let me look at where are we at on the daily here.
So 38.
Look, as long as we close above 38 here, we're probably fine. So that's sort of we might come down and we're going to test this 8 support level again, but we've had a fairly bullish run here, and it's going to take a little bit of a breather at this moment. But I think once you see, this is what I've been waiting for. This is what has been making me damn nervous. Because like, why is this ship not moving? And it left this morning. So, which is finally, it's like, oh, finally, Wes Edens is not gonna let me down. He's always gonna somehow come through, and he's gonna stop talking about basketball
stadiums. Yeah. Yes, it's just not, that metaphor's not taking off. It's just
no, tell me about it.
Just say we're not going to spend any more capex, and the analysts will be content.
I mean, and NFE has been my big winner. I mean, without a doubt. I mean, I'm up so much on NFE this year. It's ridiculous. I've actually made enough on NFE options that it covers my basis. So
incredible.
Which is great. It's just fantastic. This is now free writing shares for me. As I'm sort of looking at this, and I was like, look, what was my profit and loss here today? I was like, oh, really? You don't say.
Let it ride.
All right.
Let it ride. We got a long way to go on this. I was going to say train, but on this LNG floating.
Well, that's the train. The train is actually what they call the liquefaction lines. So,
so let's talk shipping, because
shipping. Oh God, no.
This is very topical. Okay. I mean, I've looked this morning. I had this. Yeah, we do need to talk about that. I've got this crappy little $30 million market cap dry bulk producer that has a dry bulk shipper that's just gone through the roof because people are worried. Oh yeah.
What's the? Yeah. Oh, okay. Because there's just the canal and all the other stuff.
No, sir. I'll send it to you in a DM.
Okay.
Anyway,
I'll take a look at it.
Anyway, where was I going with this? So people are worried. People are worried about the Suez Canal, the Panama Canal shutting down. This is going to add a lot of dry weight tons. Do you have any exposure to shipping outside of Coolco? And then we need to talk about Coolco, because people are giving this thing away, and I don't understand why.
All right. So I mean, the Coolco thing is, in terms of like my exposure outside of Coolco, is no. I generally stay away from spot rate shippers. So a lot of crude tankers that seem to live and die on spot rates. Just because I don't follow shipping closely enough to be able to. I mean, like Coolco was like, for Coolco to become a long for me required like, several weeks of research.
That's fairly straightforward. I mean, there aren't many gas plays, I mean, discount to replacement value, and they have backlogged. They've contracted their revenues. I think that's the big one.
Correct. And now, look, I can actually show you guys my. I can stop the share here, and I can actually just show you all real quick my CLCO projection. So this, I have all the ships basically out here, and then financial statements. So, this is what I was expecting for this most recent quarter.
Yeah.
We beat my bottom line estimate. And,
zoom in. I can't see. So you were estimating a quarterly earnings of?
Well, let's see here. Which one is it sharing? Okay, let's try this again. I was estimating quarterly earnings of 71 cents a share. They ended up at 74.
But
so
the stock sold off because
yes. Now, can you see it now?
Yep.
Okay. Yep. So, and they sold off because primarily not because of the financials, but because they have several ships here. Now go over to the fleet, and we see that we've sorry, one second. Oh, closing bell. It's in my ears.
Okay.
So we have several ships here that are now open. I'm calling them Husky and Glacier. I don't know if they're actually Husky and Glacier or not. They have not been re-signed. So
that was
they're going to get, yes, potentially, because they think that they're going to get a better rate in winter. They also have not signed Tiger or Panther, which is the new builds that are coming next year as well. So, and I need to change those because those are 2024. Anyway, So that's what, happened there. But in terms of like operations, like there isn't really a problem. Slight miss on the top line from what I was expecting. Um, but
But
that
bottom line was okay.
but bottom line is fine.
Yeah.
And they can more than less afford the dividend. I mean, apparently in Oslo, the Oslo exchange, like investors over there really like their dividends. And like
Yeah, they really do.
CLCO's yields might be great in the New York Stock Exchange, but apparently it's not good enough over there. That's one theory I've heard. The other is
With
that
like a
Pareto.
14% yield. That's
I know. Look, it is
okay.
what it is.
It is what it is. It is what it is.
Also, Pareto is a bit more bearish on them. So I don't. That's sort of the working theory. We also think that maybe it's just someone who is trying to exit. But the thing is, it's like, we're just sort of sitting here going like, guys, New York is just buying your dip. Like, stop selling. We
Yeah.
want the stock. So I think CLCO is, I'm pretty comfortable in saying CLCO is probably bottomed here. I have gone back into CLCO. I pretty much bottom ticked it at $12.11. Strangely enough, the exact same price I originally bought it for, because I got out of it some time ago. But then after this sell-off, I was like, this is cheap again. So because it seems like it was losing some steam, let's be honest, and it was. So I got out of it. Now I'm back in. And I'm perfectly happy with holding this. It's
Absolutely. It's not like a whole new bunch of ships are coming online to eat their lunch, and that's why they chose not to sign in a contract. They think they're going to get higher rates. Yeah, if they leave it a little bit longer. And I agree
and
with
apparently, like how warm or cold winter's going to be. I mean, look what TTF is. TTF was, I think, was down today. I mean, so apparently there's sort of whatever.
Okay,
It's
but
it's
spot
1 day
rates
of
are
price
still over their
action.
break even, right? Like it's
Yeah,
so
exactly. I mean, so there's still like they have a fairly wide wiggle room here too. Because look, the way that CLCO works is this is the one business where leverage actually makes sense because you have your cost of your leverage, which is basically your cost of your fixed assets. And then you have a return that you get on your day rate.
Yeah.
So as long as you're going to be over that 7%, just leverage away. Who cares?
Absolutely. That's it's a cyclical. When times are good, that's when you got to make it because you got to amortize the rest of the decade, probably where you're not going to be making money at all.
Yeah.
Right?
So, as long as your fixed price, as long as your charter revenue is basically sort of above your interest expense here, which is $15 million and some change a quarter or thereabout, about 20 million now, then, you're fine. And that's sort of how this works. You got 20 million in interest, you against that to 92 million in revenue, and what they pay out a dividend of about, I don't know, $20 million or something like that, $25 million. So
it's about
it's fine.
94, or last quarter is about 94% of their
Yeah.
their
So
operation.
I mean,
So
yeah. So you've got enough money here to afford this dividend. I think there's some question as to whether they might raise the dividend next year. And if they didn't raise the dividend, some people are in this thinking that they're going to raise the dividend because they're going to have a higher day rates potentially.
maybe, or they could just pay down debt and.
Or they could just pay down the debt. I mean, I wouldn't mind that.
Yeah,
So
that's me neither. Those okay.
but I am
Interesting.
expecting, I haven't adjusted this, but I would expect it over $1 next quarter at least, probably over. I mean, my current EPS quarterly estimates is about
Gee,
$1.26.
how
And
terrible on like a
these have
12.
actually been conservative to what these have been here. So, we'll see. But look, CLCO is it's not doing what I expected it to do, but also, the European energy crisis is not playing out 2 years in a row.
Yeah.
Yeah, it happens. But it's still a cheap asset.
Yeah, exactly.
But
Exactly. It's
but
certainly not
shipping
making
is
wrong.
so like shipping is such a, it's like natural gas for people
Oh
who like
God,
fixed
don't say
assets.
that. Don't say
It really
that.
is true. Um,
But yeah,
but
I
for
know
people,
where you're going with that.
yeah. So because it could just be, there's a lot that has to happen for me to be comfortable and de-risk a shipping asset. Now, if I just don't know enough about it, to be honest with you. I know I asked some people, But for me, I mean, the best that I can tell you is that, you know, if valuation is good enough, then well, who cares? If you've got, I mean, look, for CLCO, their current operating is this what this is, this yield, this price is good through like 2026.
Yeah.
So, and there's only
I don't know.
upside here.
Yeah. The way I look at it, if you want to, the replacement cost new, you're looking at close to $20 a share as of last
Yeah, exactly.
last I looked at it. So I
So
still hold CLCO. Speaking of cyclicals, last one before I go to run, Sibanye-Stillwater. Sibanye-Stillwater. It's tempting me, Chappie.
I know it does. It does look like it's attempting, you know, Sibanye. Look, platinum prices have just, you know, platinum prices are just collapsing, and lithium prices, God knows where the bottom is. Sibanye did the right
Platinum, it doesn't
thing.
make a lot of sense. And they are a top
I
10
know.
gold producer as well. And
Well, their gold they break even on, because their gold is actually they use the gold for like a production credit. It technically lowers their fixed their operating cost.
okay.
But having said that, because they assign certain costs to their gold, basically on operations, and then they use that as a credit to essentially. It's why their South African mines make money and why nothing else does. That's the problem with Sibanye, is they have the South African assets that make money, and they have everything else that doesn't. That needs a higher platinum price to get there, and
The objection or the rebuttal to that is that if South Africa finally just, if it just production just stops for whatever reason, of which there are many, that would act as a tailwind on the prices for their externally located assets.
potentially, yes, and that could happen. To me, I think I would want to see I would want to see a higher platinum price, higher palladium price as well. It's palladium actually is where they made a lot of their money. A lot of people don't really quite realize that, because they produce palladium in South Africa, and palladium prices. You thought platinum prices went crazy. It's palladium prices that went insane, and palladium is apparently is interchangeable with platinum in terms of like those catalyst metals that you would use in like a catalytic converter.
Yes, but you
And
can't use them in the medical applications where you can with platinum.
there, sure, exactly. So, you know, another application. Now they diversified. They used a lot of that cash that they got from the platinum and boom and platinum and palladium boom over the COVID period, and they diversified into a lithium mine, and they bought a zinc reformer, or zinc. I don't know what they call it. It's another project in Australia. Doesn't make money. They have a nickel refiner, I think, in France. Also doesn't make money. And they're bringing on this lithium deposit in, I believe, Norway. That has a sort of it has a break-even cost of about $7,000 per lithium carbonate ton. And yeah, we're at like 17, 18 now. But when they did their definitive feasibility study and their FID, it was like 26. So lithium prices have come way down. And you know, God knows where the bottom is, you know, because but having said that, so we'll see. I mean, Sibanye is it's not a sell for me. It's also not really a buy. If you're bullish on platinum, why not? You can, I don't know how much cheaper Sibanye is supposed to get.
Yeah, well, this is,
and if that's an area that, you know, you want to play in, there's nothing that's sort of like, I went through it. There was nothing that sort of highlighted it to me as like, oh God, this is a short to Hades. But there was also nothing really that made me want to just drop everything and buy it now. So I don't know. It's the fact that they're just so completely reliant on their South African operations just didn't leave me with the warm and fuzzies. So
yeah, one or two.
I don't know. It is what it is.
One or two things have been known to go wrong down there.
Yeah, just a few. Like, yeah, who knows what'll happen? But you know, it's I don't know. We'll see how it goes. But to me, I don't know. I'm more interested in like ADT, which is I believe silver
It's
and
polymetallic, but people are excited about the silver
yeah, it's like it's
aspect.
zinc silver, I think.
Yeah,
Um,
that sounds
and
right.
I have a projection on that basically says that this is actually a good entry price here too. Um, and they keep on
Basically at production
increasing the
too, right?
resource.
So, yeah.
Oh, but that's another one. If you really want to get into the metals, Adriatic has my blessing. So
Okay. All right. There we go.
yeah.
Well, we covered a lot of territory. Thank you. Before we wrap it up, where are you most bullish at the moment?
Oh man. I mean, I
Petrol,
still remain most bullish on oil. I think
oil.
this is
Yeah.
just it's just noise. I think you're gonna see decline rates in the Permian. That's gonna be a thing here soon. I don't know. I mean, it's just I think oil it should be between 80 and $95. I think 85, 95 is sort of the sweet spot that everybody's happy at. And I think it's gonna get there because that's where everybody wants the price to be.
Mhm.
So, and there isn't really a cheap, low cost producer that's sort of engaging in a price war right now.
Yeah. Exactly.
I mean, it's not like, so I don't know what is going to happen there, but I do think that oil is just too cheap right now. And I think there's just a lot of noise around there around that. So,
I agree.
to me, it's in terms of like the resource space, it's where I'm most comfortable being. So
I like it. All right. Thank you, sir, for another wonderful chat and links
hopefully,
to.
yeah, this is very concise. Everyone should love this one. So because usually I'm rambling all over the place. I felt a little pretty good today.
I do my
But
best to
anyway,
I do my best to guide you, but it,
yeah, and thank you because you're really good at that. So anyway, people can go to my Substack Proven Reserves. I've got this
link
information.
in
I've
the
talked more
description.
about this. I've also had the NXC projection, and I'm going to be going more in depth on these various projections as well over the next couple weeks. Just like taking people through this, and eventually I'm going to find a way to get it to people. Like how you get this and how people can download it is I've never quite figured out how I want to make that easy, but because eventually I want to go
there is an
through.
option
Yeah,
to copy the spreadsheets
yeah, I think so. And then I
and
can also
edit
just
it
send out
their
emails
own
to.
copy. Yeah.
Mhm. I
Anyway,
think
we
so,
can
and I'll
cover.
probably just send it out via emails as well. I could just probably end up doing that, but I want to go over the spreadsheet so people know because they're all quite sort of different, and based on what I wanted to put in. So and I like to have these various adjustment factors so people can come in and actually
Make sense of the ginormous amount of numbers.
yes, and it's a huge amount of numbers, but usually, and I price everything really, and you have to understand, like for Boss, for NXC, and for Global, also for Global. I also want to point this out about Global. Unlike NXC and unlike Boss, I did not price in a residual share value for Globe. Your global return solely dividends, or what I would project dividends to be.
Ooh,
No, like nothing there of like, oh, you've got 4,000 shares and you're going to sell those 4,000 shares at the end of like 7 years at, I don't know, $2 or $3 or something.
yeah. So
Didn't
purely
do that.
yield based returns in those
Purely
calculations.
yield. Whereas the others required
Yeah,
like some
equity
kind of, what's this going to be worth at the end when you decide to finally sell? So
yeah.
just pointing that out there. There's like
Putting it
one
out
line,
there.
folks. It's called
Yeah.
Global.
Okay. Um,
So
there we go. Has Chappie's blessing. Take care, guys. Do your own due diligence, and we'll be back with another
please.
episode shortly.